Joining us now, GFM Focus Investing co-founder Anand Badapati. Anand, give us your big picture perspective. Why are you so bullish on these names, and how much of this really just has to do with the reopening of China?
It has to do less with the reopening of China, and it's got a lot to do with the underlying business strength and the valuations that you're getting these companies today at. The short version is these are excellent businesses. There are very few companies you can count on, fingers of your two hands that generate $15–20 billion in free cash flow every year. Alibaba and Tencent are two of those names. The short version is their business is going through a bit of a change, but the risks are so heavily overpriced in the valuations that you're getting a couple of their underlying businesses for free. And with softening of the regulatory clampdown, which we've seen some indications of, and with the Chinese reopening, which is going to hopefully boost consumer activity for companies like Alibaba and Tencent, there are a few catalysts, this being one of them, that are going to slowly pay out. This is why we are bullish.
Yeah, and it's interesting, Anand, because you're bullish on these companies, but you say they're not for everyone. You have a couple of caveats. Walk us through what those caveats are.
Well, the first thing is it has to do with investing in China. So if you cannot hold your stomach and hold your breath for something like 3 or 5 years, then you should not touch these names, because anything can happen over a 6-month period. You saw that play out in gory detail and with a lot of drama over the last 12–18 months. Some of that is not going away. The government crackdown is a real factor. The government interference in business activity is a real factor. But that being said, these companies have really some of the best businesses in terms of profitability and growth targets and management ability across anyone else in the world. And you're getting them at less than liquidation value in many of these cases. So you just have to sit there and hold your stomach and believe that the underlying business will shine the headlines over a period of several months and a couple of years. If you can do that, then you can buy it. Otherwise, you should stay away. It's not a trading stock.
All right, Anand, so a lot of breath holding, a lot of stomach holding here. I want to ask you about two different things. First, your position on COVID. It sounds like a lot of your thesis relies on China reopening. We're seeing reports of people going from mainland China to Macau and also Hong Kong to get an mRNA vaccine. So how much of your thesis is based on China actually getting one of those mRNA vaccines? And then second, U.S. chip restrictions. Is that going to impact these Chinese internet stocks in a meaningful way?
The COVID mRNA vaccination question that you pointed out, it is a catalyst, but the overall catalyst is the general reopening and the normalization of physical restrictions and business travel restrictions that have heavily clamped down on business activity. And you can see the effect in like, say, the earnings reports of many of these Chinese companies, like Alibaba, for example, which had the first down year I think, since the IPO. So it's not exactly the mRNA vaccine, but the overall softening of COVID restrictions that I think is going to be a near-term catalyst. But that's not really a reason to buy the stock. That is one of the factors. The second thing you pointed out was about chip restrictions. It's certainly affected companies like Alibaba. The second biggest business is cloud, and they recently could not get their hands on some chips. And now Alibaba is probably the third biggest cloud company in the world, or fourth biggest, depending on how you count. And it counts as its client base approximately 2/3 of listed A-shares companies in China. So it's the AWS of China, if you like.